Yeah, Greg's in that case, to revisit a theme that we've been talking about a fair bit this year. That stock did very well after its Q3 trading update, which basically tells you the kind of sales numbers and no other ones. Shares were up 7% on the news, and I looked at this before the market opened and I said to you, I think it looks rubbish. And I still think it looks rubbish, having looked at it afterwards, but the market didn't think so, or at least the market sent the thing higher, 7%. It's come down a bit today. It was yesterday, October 1st, that this was released, and we are now talking about it on October 2nd after a bit of a down day has brought this back into sort of a couple of percent higher on the week, and I could sort of maybe live with that, but a 7% jump seemed like a bit much to me here. I saw, with Greg's, so far what we've seen is, roughly speaking, a difficult few months and very slow like-for-like sales growth, largely driven by new store openings and so on. And the big question, I guess, is whether this is what the long-term outlook looks like for this company, or whether this is a kind of temporary dip based on things like, but not limited to, the weather. And from what I saw of this, I saw pretty much no signs that things are improving in any meaningful way. Whether it's temporary or whether it's permanent, I don't know. But this didn't give me any reason for thinking things were about to start looking up anytime soon. Anyway, sales then. They were up 6.1%, and that's the number that a lot of people who are optimistic about this and say that this was great, was the word that someone used to describe it on a Trading 212 forum, which is not the word I would use. 6.1% sales growth, that is what it is. Your sales went up by 6.1%, well done. Largely the result of higher store openings, so they actually opened and closed quite a few to leave themselves about 50 ahead on the quarter. But on a like-for-like basis, and you can't keep opening stores forever and so on, you can't keep shuffling your deck indefinitely to generate growth like that. Like-for-like sales were up 1.5%. 1.5% is rubbish for pretty much any number of reasons you like. First of all, it's below inflation, which is the thing I always tend to look at. I tend to want to see like-for-like sales doing better than inflation. The second reason it's rubbish is it's going in the wrong direction. In H1, which, by the way, has seen the stock crash by, 30-something percent, because sales have been quite bad for reasons of it being too wet or too hot or too something. Like-for-like sales growth there was 2.6%, and it was trending higher from Q1 to Q2. So I thought maybe. My prediction for this one, by the way, was the stock would go up, but it would go up on like-for-like sales growth of somewhere in the region of 2.8. So what I consider to be not very good, but clear positive direction here. Actually, what's happened is it's gone the wrong way, and the stock has still gone up. So make of that what you will, but in what world that's better, I don't really know. So the big question becomes, why is this stock climbing? I've got three ideas for you. One is that the market was expecting worse. Obviously the market was expecting worse, but in the sense of they've been blaming warm weather in July. That, of course, is part of the current quarter. They put the July report attributed warm weather in June to being a major reason why people were consuming less Greggs products. Fair enough. The decent weather actually hung around for most of the summer, which might have caused you to worry on broadly the same grounds that sales were going to come in light for this quarter. And maybe they were expecting worse than the 1.5% like-for-like that they got. Possible, I guess. Another is that at 11 times earnings, this thing is actually really cheap already. And any kind of positive like-for-like sales is arguably not to be sniffed at that level. So for context, it's about the same multiple that ABF, Associated British Foods, is trading at. And Primark's like-for-like sales are going backwards. They are not growing at anything at all. They are down in pretty much nearly every geography. I don't think they report them for the US, but the US is growing rapidly for Primark because they're opening so many stores and they're still a fairly small operation there. But in nearly every area that I could see, Primark's like-for-like sales for the most recent ABF report were either bad or negative, basically. So, I guess compared to that, and when you think that you have a choice between 11 times earnings for ABF, which is Primark, and a bunch of other businesses, I don't really rate them more that I look at them, to be honest. Or 11 times earnings for Greggs, which is moving forward, albeit very slowly, and maybe you give them some credit for a difficult environment and so on and so forth. Okay, maybe that's a sign that there's a bit more to be had from this thing. And the third idea, and this is the one that I kind of get a little bit more, today makes me think this a little bit more than yesterday, to be honest, is there was, by UK standards, quite a significant short interest going into on Greg's going into that earnings print. And when you have quite a significant short interest, a small move can turn into a big move going higher as people who are short suddenly find themselves needing more money on hand to cover, or they have to buy the stock. Basically, the cost of being short is higher when things are going against you. And if they have to buy to cover, that creates more buying, which drives the stock even higher and turns, a couple of percent move into a 7% move, maybe. Not sure. There was quite a substantial short interest in Greg's before this. I thought shorting this was a risky business because I thought at the start of the year it made a lot of sense. What you're seeing is a company that is going to start slowing sales. It's moving into kind of phase 2, and sales growth is going to start to taper off a little bit as they start reaching saturation, maturity, call it what you like. And in those situations, when you have something trading at a big-ish multiple, that multiple regularly comes down when people think we're out of the fast-growing phase. It doesn't look to me like it's currently trading, nor did it look to me on the start of the week like it was trading at a particularly high multiple here. It implied significant growth. It appeared to me like it was trading at a multiple that implied, well, maybe about 1.5% growth, to be honest, with that kind of result. Certainly on a like-for-like basis and a bit more of a push from opening more stores. So it's back down again. When I looked, it was down 3.5% today, up 2.68 in total for the week. Is it worth it with a 4.2% yield? Maybe, maybe not. We've talked about this one a few times. I don't think it's the worst idea in the world. We can get on to what I think is the worst idea in the world shortly, but I don't mind anyone owning this at a 4.2% yield and maybe taking a bit of a shot at this one. I didn't see anything in this report, though, Steve, that tells me that the worst is clearly over and that the stock is now ready to rebound in any meaningful way. Did you?
No, but there was sort of hints in here that things are getting marginally better, and I think that's kind of how they described some of it. So they were saying that cost inflation for them, they have a marginally better outlook on cost inflation than they did previously, which could mean there'll be a little bit of improvement to the bottom line than what's currently expected. I also saw that they're testing automation in their frozen product line, which again could give you reason to think that the bottom line might improve a little bit. And the other thing I saw, which I thought was very positive for them, was that the frozen range at the moment is as of last or a couple of months ago, was only in Iceland. It's now in Tesco's as well, and it's been rolled out pretty quickly into Tesco's as well. So Iceland, that deal's been on for I think 5 years now, and they're in 930 Iceland. So that's pretty good. The Tesco deal has been live 2 months, and they're in 820 Tesco's already, and available on Tesco online. So I think that will give them a nice little boost. I don't know if you've tried the bake-at-home stuff from Greg, Steve, but it's actually surprisingly good. It comes out as pretty much as good as the shop-bought stuff, which is unusual because we've got another local bakery which does bake at home in some of our local stores, and it comes out terrible. It's absolutely atrocious. It's like really soggy. Like you'd mop your floor with it. You wouldn't eat it. So Greg's does not. Greg's does come out really, really well. So I think that's an interesting move for them. I like that they're closing shops, Steve. I think 73 closed shops, 39 of them became relocations, 57 net new openings is interesting, 2,675 shops at the moment, with about 500 and so of those was franchise units, if I remember in the report. I thought it was pretty interesting. There's a Sainsbury's deal on the cards as well, they were saying. There's a potential for that we'll see that, the frozen range dropping into Sainsbury's. So look, there might be some reasons to be positive here, especially if you think the expansion that they're doing. They've got a place opening in Derby in 2026, a distribution centre in Kettering opening in 2027. One of them for ambient, one of them for frozen. They're obviously see that this is a couple of growth areas here that could be interesting. The frozen part of the business that we were not so interested in before may become something that you should pay attention to as an investor. I don't know, Steve, though. I'm not in a rush to go and buy Greg's here. I thought this report, like you did, Steve, was was really poor. When you flagged it to me, I went and read it, and I was really disappointed with it. I thought, well, come on, this CEO must be under some pressure because she's just not delivered anything since she took over. But I think it might be a wait and see story. I think once these new facilities are online, these deals with Sainsbury's and Tesco have kicked off, it might be interesting to see how they do from that point onwards. The problem I've got in the back of my head is I don't know if you remember Thornton's. I don't know if it's even still a thing, but Thornton's tried this. They had a lot of chocolate stores up and down the country, and it was a little bit of a magical thing to go into a Thornton's and get your chocolate. And they thought, well, let's start slamming our stuff into supermarkets left, right, and centre and sell more Thornton's. And what it did is it devalued the brand. It devalued to the brand to the point where nobody bothered going into Thornton's, because why would you bother when you can just go and pick it up from Asda and it's like 2 for £5 rather than like £7 a box. And Thornton's ended up doing really, really badly out of the deal. And there is a feeling that, with Greggs' frozen product being so good and cheaper than getting it from a Greggs, why bother when you could just, take it home and enjoy a steak bake when it's not too cold or not too rainy or not too hot, Steve, when the weather is perfectly ambient and the only temperature that people could consider having Greggs. Thoughts on that?
I think so. In some senses, I guess there might be a difference between Thornton's and Greggs in the sense of the product they sell in Tesco's isn't strictly and literally the same thing the product they sell out of their own store, because you can eat the one straight away from their stores, which I strongly suspect is why people are going in there. If they start trying to flog donuts out of Tesco or whatever, I think that'd be a terrible idea, by the way, because Tesco's has a bakery arm to it. So I
And
don't
Krispy
think that
Kreme.
would, and Krispy Kreme as well. Yeah, I think that would, which is I think bad for Krispy Kreme, and makes me wonder why anyone goes into one of those when you could just get the thing out of Tesco. I saw a report the other day that another arm that Greggs are opening, and I mentioned this at the start of last week's show, actually, when I looked at my notes for updating them for this week. They've opened a pub, Steve. At the time we recorded last week, they were about to open a pub, and in the time that's passed, they have opened a pub. This is incredible to me for several reasons, but not least, there are several industries that I don't like right now. As a whole, I don't like the pub industry. I like certain parts of the pub industry, but if I was Greggs and I was trying to think, how can I make my business go better? If I was basically anyone and trying to think, how can I make my business go better, short of being a pub business already, I don't think the answer would be, I'm going to try and open a pub in Newcastle, I think is where it is at the moment. And I have no intention of visiting it because it's too far away. I don't really want to go to a Greggs pub either. But I don't know, they've had some sorts. I don't think it is, by the way, just flogging steak bakes out of a pub. But they appear to have some more things that I think closely resemble food. Maybe they sell Chinese tapas in there. Who knows? But Greggs have had some useful collaborations before. Actually, I remember their Primark range. I mentioned ABF before, and so far neither of those companies has done terribly well this year. But I'm interested in it's interesting to see things moving in the right direction below the surface, I guess, for Greggs. The most interesting bit being probably the bit you mentioned first, which is the slight improvements on inflation. We will see, I guess, when 3 months from now expires, and we'll take a look at where they're at the end of the year, or start of next year, more accurately, because that will be about a year after they started really going off the rails as a stock, and they had their big kind of 25% in a day downer because they put up a poor Q4 report and then said the first 3 weeks of Q1 have been bad as well. And that raised real problems for the stock. But we will see. I take the thought that there is, on closer inspection, some positive to be found there. But the market's settled down a little bit on this and said, okay, 2% worth of positives rather than 7% worth of positives. And that probably seems reasonable to me.
Just to sort of finish that point, Steve, before we shuffle on, it's a pub in a food hall in a department store kind of thing. So it gets a little bit worse when you think about it a little bit more. than that. But yes, there is a Greg's Carvery on a Sunday though, Steve, which you must be willing to try that. I assume. I hope it's not the steak from a steak bake, because I've always kind of thought to myself, I wonder what kind of steak that really is. It seems to be so soft, which you just wouldn't really say. There's no chew to it whatsoever. I was going to make a joke about no teeth in Newcastle, but it's too rich coming from somebody from Hull, isn't it? So I'll probably skip that joke.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.